Good morning. Then I think we have few things under the capital budgeting also. If you remember, we discussed up to IR. We finish it. So I think I need to explain this profitability index. This one IRR and then MIRR. This one also I asked you to do this calculation at home to check this thing. Right. So the last evaluation criterion is the profitability index. So this one profitability index also is an important evaluation criterion. We can use to evaluate the project to decide whether accept or not. This is importantly applicable when there is a fund constraint. Fund constraint means, suppose that we have many projects with the positive NPVs. NPVs are positive. So if the NPV is positive, that project is okay because it is a value created project. But limited budget. We have only 1 million for the investment of this kind of project. So when there is a limited budget, or we call fund constraint, to rank the projects, we can use this profitability index. Because if you look at the way of calculating this, profitability index, you can calculate present value of the cash inflows divided by initial cost. Present value of the cash inflows of the project divided by initial cost. So this is a ratio. This can be 1, greater than 1, less than 1. So likewise, you will get the answer. If the profitability index is say 1.2, say profitability index is 1.2, so we can accept the project. When the profitability index is greater than 1, you can accept the project. What is the meaning of that? If you invest 1 rupee in this particular project, you will generate 1.2. So that is the way of interpretation, this 1.2. So then how much the value creation? How much the value creation through this project? 0.2. 0.2. Right? So this is important, applicable mostly when there is a fund constraint. If you have limited money, limited budget, so then you have to rank the project using this profitability index. If you invest 1 rupee, this project creates 1.2 rupees. Right? With the limited budget, so this is very important to rank the project. If it is a 0.8, profitability index is 0.8. Less than 1. So this is, we are not accepting. Because if you invest 1 rupee, you will end up with a 0.8. 0.8 cents. So that is value decreasing. So therefore, this is not normally accepting when the profitability index is less than 1. If it is equal to 1, either you can accept or reject. So it means that this is not a value creation, or there is no any value deterioration or value decreasing to this one. In a conventional type project, when the PI index is greater than 1, NPV. What is the NPV? Is it positive, negative, or zero? Yes. When the profitability index is greater than 1, normally NPV is positive. You will get the positive NPV. When the PI profitability index is less than 1, NPV is negative. When profitability index is equal to 1, NPV 0. NPV is 0. So that relationship also you can have between the profitability index and this NPV values. Reinvestment assumption, that is important. All these techniques are with the reinvestment assumption. So here also reinvestment assumption is cost of capital. So when we calculate this profitability index for a project, the implied reinvestment assumption, we assume that returns or the cash flows generated through this project, we are reinvesting at cost of capital. Right? right? So that is the reinvestment assumption. Those are some characteristics. Consider time value of money, years, because profitability index is equal present value of the cash inflow divided by initial investment. Then assume the cash flows are reinvested at cost of capital. So that is the implied reinvestment assumption. If suppose in your exam you are getting a question, so you will get an answer with a disagreement. NPV and the PI disagree. Right? Disagree means PI index say accept project A, NPV say accept project B. NPV, normally with the NPV you may select the project with the highest NPV. Eh? With the highest NPV. So accordingly it says that you should accept the project B. If such a disagreement if you face in the exam, so you can take the decision based on NPV if there is no any capital rationing. If there is no any capital rationing provided in the question, so you can end up with, you can take the decision based on the net present value. But if fund constraint is there, then you have to take the decision based on profitability index. Right? If there is no any fund constraint, so you can take the decision based on net present value. If there is a limited funds, if you have limited budget, so then you have to take the decision based on profitability. If there is a disagreement between these two, NPV and PI index, so you can take the decision based on the NPV if no any fund constraint. Relative measure of the wealth, because it shows increase of the wealth per 1 rupee of investment. Now here, this is probability index 1.2. So this is a relative measure of the wealth. If you invest 1 rupee, your wealth will be increased by 0.2. Right? So that is the relative measure of the wealth. So when limited funds, you know that money is limited. Funds are limited, not unlimited. So we have to invest in the effective way. So then mostly you have to use probability index to rank the project with the limited fund. So this is a relative measure showing wealth increase per rupee of investment. The rupee wealth is so that is a good indicator. So this is preferred under the capital rationing. Capital rationing means same thing, fund constraint. Capital rationing means fund constraint. Right. So then you can see the example. Just quickly we will do this one. You have to calculate PI profitability index as well as NPV. Now you know how to calculate NPV and the things. So look and do quickly. So there is a project, cost is 60,000 and it is expected to generate cash flows 24, 32, 28,000 and 8,000 in 4 years. So if cost of capital or the project required rate of return, discount factor is 10%, the NPV and the profitability index. So you can calculate NPV is equal present value of the cash inflow minus present value of the cash outflow. So 24,000 is the year 1. So you have to discount it using the cost of capital 10% for 1 year. Year 3 we expect 32,000. We have to discount it 2 years back to get its time adjusted cash flow. Year 3 we are getting 28,000. Should discount for 3 years back. Year 4 we expect 8,000. 1.1 into the power 4. So this is the present value of the cash inflow. From this answer, you have to subtract, you have to deduct cost present value of the cash outflow. So that is, this is a conventional type project. So the investment given at 0, you can take as it is. It is 60,000. It is 60,000. So then, what is the NPV? Is it positive or negative? Percent value of the cash inflow, what is the answer? Is it 74,765? 74,765. So it will have positive NPV here. Then calculate profitability index. Definitely it will be greater than 1 because profitability index is equal present value of the cash inflow divided by cost. So here the answer is 74,765. Present value of the cash inflow divided by the cost 60,000. So you will get profitability index 1.25. So these are the answers. Now there is no any disagreement, no any issue because NPV is positive, PR index greater than 1, no problem, you can accept the project. This is mostly the disagreement is coming when you are evaluating mutually exclusive project. You have to select only one, so then this kind of things will arise. But anyway, in your exam, in your level, you will get the project like this. So therefore, that is easy. Now look at this one. You are given two projects. Suppose these are mutually exclusive. From these two, you have to select only one. Evaluate two projects by NPV and the profitability index, and select and recommend one. So what is the NPV here for the project A and B? What is the NPV? Huh? NPV, right. So according to the NPV, so you should select which one? A or B? B. Calculate the PI index. Huh? So what is the PI index? You will calculate it. Tell me the PI index for the project A. So NPV is there. NPV project A, given it is 40,000. How much the PI index? 0.2. How do you calculate it? NPV divided by NPV divided by initial investment. NPV divided by initial investment. NPV means difference between the present value of the cash inflows and the present value of the cash outflow. So that is the NPV. The PI index, when you calculate the PI index, is it correct if you divide NPV by the cost, NPV by the initial investment? Is it correct? So PI index you can calculate. This is the formula. Profitability index is equal present value of the cash inflow divided by the cost of the project. This is the profitability index. So NPV for these two projects are given. Project B 70,000. PI index is what you calculate. Good morning. Throughout the semester, coordinated the came with delay. Isn't it? 1.2 project A 1.20. How was the calculation?
Next question there will 40,000.
Present value of the cash inflow now in this project A, there is a positive NPV 40,000. So to get this positive NPV for 40,000, present value of the cash inflow should be greater than 40,000 from the cost. Okay? Cost should the NPV 40,000 and the present value of the cash inflow is equal 2,000 plus NPV. So that is 240,000 divided by the cost of the project 200,000. So then you will get the PI index for the project A 1.2 and 1.2 project B 1.175. I'm looking for 1.18 here. Right. So now, according to the NPV, project B is the better because it is the one with the highest NPV. Project B is 70,000. According to the profitability index, which one is recommended? According to the profitability index, project A, because profitability index is highest for the project B. Now there is a disagreement. So these are mutually exclusive projects. Now which one you are select? Under the condition, suppose that there is no any fund constraint, no any capital pressure. So what is you are going to select? If there is no any fund constraint, capital rationing, you have unlimited funds for the investment. So which one you may select? Project A, based on the NPV. Now, suppose that there is a fund constraint. The company has limited funds for the investment. So then your decision, project B. Because with the fund constraint, you have to select the project based on the profitability profitability index because it shows the relative increase of the wealth per rupee of investment. රුපියලක් ඉන්වෙස්ට් කරොත් මේ ප්‍රොජෙක්ට් එකකින් වෙල්ත් එක 0.2 වැඩි වෙනවා. දැන් රුපියල් ලිමිටඩ්. We have limited funds. Rupees are limited. So if you invest 1 rupee, you will get 0.2 wealth enhancement, wealth increase. So therefore, if there is a fund constraint, you have to take decision based on profitability index. Right. Okay. So conclusion, net present value method is the most superior investment criterion as it represents the net increase in the firm's wealth. So because in your this course you are getting only the conventional type project. So you will not face to the disagreement such. So therefore you can take decision mostly based on the net present value. If the question if it is there given a fund constraint, so then you can take the decision concerning the profitability index also. Right. So this is end of the capital budgeting. So I will today I want to discuss this capital structure and leverage things also. Actually, I am not going to discuss this question in detail, but I will give the answer in the homework. As the homework, you can check this because this is very easy. So you can see, just look at the question because I cannot do everything in there because we have 3 hours to make there are 4 projects. So you can see the life of the projects. This is 4 years. Project C 4 years. This is 2 years. So 1 year, so likewise 4 projects following investment project. So what it asking, rank the projects according to each of the following methods. So you have to calculate payback, IRR, net present value for each of the projects, right? So you know how to calculate this thing now. You can do, you should be able to manage, right? Because you have that. So then ask, if projects are independent, which project should be selected? If the projects are mutually exclusive, which one is the best? Right? So if I go on to do this calculation here, it takes more than 45 minutes. So therefore, I am not going to take that during this time. So, but these are the answers. Right? So these are the answers. Payback period A 1 year, payback period B 1.3 years, 2.3, so likewise. IRR, you know how to calculate IRR, internal rate of return for the project A 0, because if you look at the project A, you can see it is 1 year investment and the input outflows and inflows are equal, so therefore IRR is 0. You can calculate and you will get the answer. B 31.8, 26 for C, 37.6 for D. NPV, in the question it says assuming discount rate 10% and 30%. So you ask him to calculate net present value taking 10% discount factor, cost of capital, and also 30%, both. So at the 10%, project A negative NPV 909, project B like this 3060, 4139, 3824 at the 30% discount factor. So these are the NPVs. So these are the answers. Now tell me, if projects are independent, right? If the projects are independent, which project should be selected? If projects are independent, which project should be selected? Now, you have to consider both 10% discount factor as well as 30% discount factor. Now, payback period actually is not a significant value because you know that the limitations of the payback period, but collectively with other numbers, payback also you can have because you will get some understanding about the liquidity and the risk of this particular project by looking at the payback period. At the 10% discount factor, 10% cost of capital level, which project should be accepted? If you consider the 10%, which are the acceptable projects? See the high that 10% cost of capital level, B positive NPV, C positive, D positive. And also if you look at the IRR greater than 10%, this is also greater than 10%, greater than 10%. So you can accept B, C, D at the 10% level. If 30% cost of capital level, if you take the 30% as the discount factor, so which are the projects? So you can accept B and D because you can say this is negative, project C, NPV also negative. So therefore B and D. At the IRR, at the 30%, only B, D because this is 26% IRR less than the 30%. Next, so that is you cannot accept less than the cost of capital. So therefore only B and D you can accept. Right. If the projects are independent, if these projects are mutually exclusive, so you have to select only one. Now these are mutually exclusive. So at 10% cost of capital level, which project, which is the best? At 10% cost of capital level, which is the best? C. At 10%, because it is the with highest NPV. And if you look at the IRR, lowest, all the IRRs are the greater than 10%, that is okay. But you have to go with the highest IRR. IRR එක වැඩිම එක තමයි හොඳ. ඒ කියන්නේ ඒකේ වැඩිම internal rate of return එක generate කරන්නේ. ඒ condition එක satisfy වෙන්නේ නැහැ. With the NPV, this is the one with the highest NPV. But if you look at the IRR, this is the one with the highest IRR. So there is a disagreement. According to the IRR, it says should project B. According to the NPV, it says this is the with the highest NPV. So now there is a disagreement. So what is the decision? Based on what you are going to take the decision? Based on NPV. Based on NPV. Because you know that this 3763, when you are generating this internal rate of return, reinvestment assumption, very unrealistic. 10% is our cost of capital. Ekama market ke ongoing investors require rate of return. Okay, cost of capital 10%. But this project is generating 37.63, assuming that cash flows are reinvesting at 37.63. Reinvestment assumption is IRR. It is IRR. The IRR is compared to the cost of capital is a very unrealistic reinvestment assumption. May level like capital invest 37 word, but this IRR is generating assuming reinvestment at the IRR. So therefore, if this disagreement is there between the NPV and the IRR, you have to take the decision based on the NPV. So your answer is C. Then at 30% cost of capital level, at 30%, highest NPV with the project D. So then you have to go with the project D. There is no disagreement even because it is with the highest NPV and also the greater than the cost of capital. So these are the decisions. So likewise, you should be able to. I think now you have the knowledge to discuss like this. Right. So you may calculate this IRR, NPV, payback at home, right? අපි මේ ගාන එකක් කරන්නේ එලන් මේ cash flow estimation එක කරන්නේ මම කිව්වා මේ වගේ එකක් දෙනවා කියලා model paper එක මම I put this into the model paper also. I will discuss it later. Let's look at this one. Project this. Shall we do this one quickly? You are a finance manager of DKP PSC. You have identified the following investment project with a similar lifespan. Due to the funding constraint, the maximum amount that can be spent on this investment is 2 million. There is no any chance of investing in the fraction of the project. So the project Ganwana fully that time totally we have to give up. No any possibility to invest in the fraction. Advise the top management select the optimum mix of investment. Okay, then you are given 6 projects. Budget limited budget is there 2 million. So quickly recommend optimal mix of the projects or the optimal mix of the investment subject to that 2 million limits. Will do? අදක දිගට හදන්න ගන්නවා. විනාඩි 10යි හදමු. නැත්නම් අපි කැපිටල් ස්ට්‍රක්චර් බලන්න. Because I need to do this type of action මොකද මගේ mentality එක වෙනස් වෙන පුළුවන් paper එක මේ වගේ එකක් දෙන්න කියලා. So therefore I think it's better. So you can start. So you are given initial investment and the present value of the future net cash flows are there, right? A, B, C, D. Present value of the cash inflow 1,005 28320 So you can calculate quickly FPVs because present value of the cash inflows are given, so you can calculate NPVs. Net present value. This is present value of future present value. Discounted cash flows are given. Simply the difference between this and cost is the NPV. So you can calculate net present values. now you have to rank the projects according to the NPV. So there is no action of the project, so you have to rank the projects according to the NPV and the profitability index and see the best combination of the projects subject to that 2 million limits. So if you rank based on NPV, so highest NPV with the project A, so this is the 1, then 2, is it correct? So this is 2, project 3, this is 4, 5, 6, ne? 500, 120, 150, 120, 70,000. Right. So according to the PI index, which is the highest? This one, right? 150, 1, we must say like 2, 1.28, 3, 4, 5 එකක් තියෙනවා නේ. එකම 1.12 එකම එකක් 5 same. So these are the ranks. මොකක් හරි වෙනසක් තියෙනවා කියන්නේ. Right. එතකොට limit is 2 million. We have only 2 million. According to the NPV and the PI both say project A should accept. So then let's see A plus B plus budget එක කොච්චරක් ගිහිල්ලාද investment එකේ A වලට 1 million project D 350 1350ක් ගිහිල්ලා තියෙනවා. ඒක තව තියෙන්නේ අපිට 650. Right? We have only 650,000. But according to the PI index, the third one is project C. According to this profit NPV, third rank is project F. So C එකට යන cost එක කීයද? 250. So එකට 500. දෙකම ගන්න බෑ. Project C cost is 250. Either project fourth number rank 4 ගත්තොත් එතන 500 cost එකක් තියෙනවා. ඒතර අපිට දෙකම ගන්න බෑ. We have only 650 remains excess. ඒතර අපි 250 ගත්තොත් මෙතනට C project C එතකොට අපේ total investment එක වෙන්නේ මේකට plus වෙනවා. C cost is 250. එතකොට අපිට තව 4,400,000 ඉතුරු වෙනවා. අපිට ඒක fraction project කියන්නේ project භාගයක invest කරන්න බෑ. ඒක idle fund එකක් වෙනවා. ඊට පස්සේ අපි මේ combination එකට ගියොත් A plus D plus F total investment එක වෙන්නේ එතකොට A 1 million D 350 F 500. එතකොට idle fund එක වෙන්නේ only 150,000. දැන් අපි මේ දෙකටම calculate කරොත් combined NPV for both options. You can calculate combined NPV. Combined NPV if you accept project A plus D plus C. Combined NPV is how much? A NPV is 500,000, D 150, C 70,000. So combined NPV is 720,000. Right? For this ABF, A plus, B, BF plus C. Second alternative here, combined NPV is A again 500,000, D 150,000, and F 120. 770,000. Combined NPV is 770,000. Within 400,000 only Neelam project according to the this is according to the PI index rank. This is according to the NPV, right? According to the PI index, fourth rank එකේ project F. The cost is 500,000. So we have only 400,000. So NPV based rank එකට ගියොත් අපිට 150,000 තමයි තිබෙන්නේ. ඒකේ හතරවෙනි project එක අපිට තියෙන්නේ 250 cost එකක් යනවා. So that is also you cannot accept. So now based on this you have to recommend. Here you have to look at this one also. This combined NPV also important. So look at based on the profitability index and also the NPV based ranking. So according to the profitability index and the NPV, both project A and B is okay. C and F is there is a difference according to the NPV project. The F is the third one method because it is with 1.120 NPV. According to this, this is the third rank. So what is your answer then? A, D, F. So this is the explanation because you can justify. You have ended with only the 150,000. So this idle cash question this idle funds you cannot assume that that any unused fund cannot be invested elsewhere. Effectively fund investment, if you go with this ADF, we remain with the excess of only the 150. If you go with this profitability index ADC project, so you will use unused fund. That is a wastage. Idle fund 400,000, and also its combined NPV lower. Make up very important, right? Combined NPV. So now if you go with the ADF, the combined NPV is 770,000. So therefore you can recommend this combination as the most appropriate, optimal combination for this company. Any question? Okay. Right. So there are some more questions similar to this, right? So this one also related ranking projects. This is question number 4, and this question number 2 also with the limited budget ranking. So you may try out them at home. So this is the way of doing this one. This one I will discuss with the model paper. cash flow estimation question, that question number 6 I will discuss. Right, so that's about the capital budgeting. So now we are going to the capital structure and leverage. Last. Now we have to do the working capital derivative things are not able to cover. So, but anyway, I will explain few concepts related to this capital structure and the leverage. Do you have any questions, any clarification? Right. So then we can start this one. Before starting, do you need any break? Breakfast at the already? You need a break? Online? Right. So leverage and the capital structure. This is very. I have summarized to very few concepts because with the this is also again a vast area that we need to discuss. Certain theories are there, Modigliani and Miller theories and Pekin order theories. So these are very corporate in the corporate finance. This is very theoretical things are there under this capital structure and leverage theories. But anyway, you will learn only these few concepts related to this capital structure and leverage. So at the end of this session, you will learn what is the leverage, why it is important. So what is financial leverage, what is operating leverage, how to calculate develop financial leverage, how to interpret it, why it is important. And also what is this financial leverage, why it is important for the decision making. And finally, you will learn what is this optimal capital structure. Because you have learned to estimate the cost of capital, you know the way. So what is this optimal capital structure? Under this optimal capital structure theories, there are a lot of theories. But anyway, you will learn only the concept. Right? So, because of this time limit, I have put example and the answers all in your PowerPoint. But if the time was there, I can do the calculation with you. But anyway, I have put everything so then you can understand the concept. So these are the things actually at the end of this session you will cover as a starting point. Why this is important? Because our objective in financial management, what is the objective? What is our objective? Maximizing wealth, maximizing shareholders' wealth. So this is our objective. Creating value, maximizing shareholders' wealth. So shareholders will maximization considered as our ultimate objective of the business firm. So you can remember the very fundamental, basic formula for calculating the value. Right? Value is equal based on the cash flow. We calculate based on the expected cash flow by discounting some discount factor. This is the very basic model. So value depends on the cash flow. So value affected with the time. So value affected with this discounting factor. Right? So this relationship is very clear because now you have the time value of money, you know security valuation, we have estimate cost of capital. So this is now not a new thing for you. Now here, so you can see the objective is more effectively achieved through maximizing market value of the equity. So the market value of the equity capital or say market value of the asset type of capital. So value we calculate based on its expected cash flow, maybe dividends. Based on the dividends, you can remember the security valuation. So that is we are discounting using some discount factor. In the security valuation, you define this discount factor as that investor required rate of return. With the cost of capital, if you are going to value the equity capital of the company, so this discount factor is now our cost of capital. It is our cost of capital. So this is our minimum required rate of return for this particular company should secure from their investment. Minimum required rate of return. So therefore you can see this value and this negatively related. So value is negatively related or is negatively impacted by the cost of capital of the company. So how this cost of capital is calculated? This includes cost of debt, cost of equity, cost of preference shares based on their market value. Weights we calculate based on the market value. So you can see this value and this cost of capital negatively related. They are related negatively, inversely related. So therefore, the value, so our ultimate objective is maximizing this variable, maximizing value, creating value, maximizing the value of the equity. So equity value maximization के लिए shareholders लगे related payout. So our objective is this. So in order to maximize this, you should minimize this. You have to manage this. You have to minimize the cost of capital. When this is minimizing, this is increasing. Because these two variables are inversely related. So in order to manage, in order to achieve this objective effectively, so you have to manage this cost of capital. This is strategy. We have to manage it properly. So cost of capital can be minimized, we can manage through proper use of the fixed cost. So you know what are the fixed costs? Fixed cost mean, so without impacting with the revenue or the sales of the company, so they remain constant. So these are we call fixed costs. There are certain fixed costs in the company. Either you earn profit or not, you have to bear this fixed cost, like the interest, like other operating fixed costs. Say, and I have some example in the fixed cost in the operating profit calculation. Building rent. So these are not affected with the profit. Either you earn a profit or not, either you have a sales or not, you have to pay this. These are fixed, right? So therefore, to maximize this, you have to manage this cost of capital. So cost of capital you can minimize through proper use of the fixed cost, or we call leverage. And also, you can manage this cost of capital selecting optimal mix of debt capital and the equity capital, what we call by using optimal capital structure. Actually, in the corporate finance, these are very strategic level strategies. So, as a finance manager, you should be able to manage the leverage, financial leverage, operating leverage. So, you have to manage it to maximize this. So, I will explain it example, right? Don't worry. So, we can manage this by the use of fixed cost as well as through maintaining optimal capital structure. Best level of debt capital and the best level of equity capital. So that is optimal. We will define the optimal capital structure. So this is the background. This is the what you call the wide or the broad view of this topic. Since we are going to maximize this one, this is our ultimate objective, ultimate aim of this one. So since we are going to maximize this, we should manage this properly. Right? So under this concept, under this relationship, we are going to discuss a certain variable. So you will learn what is leverage, under this what is operating leverage, what is financial leverage, and also you will learn how to calculate this, and also optimal capital structure. Right? So these are the things we are going to cover under this capital structure and leverage topic. Right. So concept of leverage. Leverage. So that is actually the very simple term. Leverage is the use of fixed cost. Use of fixed cost. In a business term, leverage can be defined as the use of fixed expenses or fixed cost within the total cost structure of the company. That is we call leverage. You might work in somewhere, so you are earning something. You have some fixed expenditure. You have to pay some insurance premium maybe there, some certain bills are fixed. But you have to pay it. You have to pay it. So these are the type of fixed expenditures. Right? So that is business term. Leverage can be defined as the use of fixed expenses within the total cost structure, with the operating profit, in the operating expenditures as well as in the financial structure. Leverage can be used to intensify the return for its shareholders subject to some level of risk. That is the important point. So this leverage, the use of fixed cost, you can use as a strategy. You can use as a strategy for what? To intensify the return. To whom? To the owners, to the shareholders of the business, subject to some level of risk. Because you know that risk and return going with the tender. Return, when you are maximizing return, it implies certain degrees of risk. Right? So we as a finance manager, you should be able to use this leverage as a strategy, corporate strategic level strategy for what? To intensify the returns, because our ultimate objective is maximizing wealth, maximizing returns to shareholders. So you should be able to intensify return for the shareholders subject to some level of risk. So risk arising due to the leverage can be categorized as business risk and financial risk. So I define one term, leverage, is the use of fixed expenditures in the total operating total cost structure of the company. So this risk arise due to leverage, you can categorize as business risk and financial risk. Right. So if you need the break, you may take 5-10 minutes because I am going to continue this much. So then I can continue until the level. Avashan? No need? Right. Right. So leverage. Continue. Right. So the leverage, I will have this. Make a number below level. Within 5-10 maximum. Collect like here and there. So risk rising through the leverage we can categorize into two: business risk and financial risk. So what is the business risk? What is the business risk? So simply, when we say the risk is we define the risk under the risk capital also, it is uncertainty about certain variable. That is the risk. Right? So then business risk means is the volatility of future operating income. Right? Business risk reflects the volatility, variability of the future operating income and depends on factors such as, so if I ask what are the factors that affected to the expected profit, operating income, or the EBIT, earning before interest and tax, that is operating profit. So there are so many factors. You can list down more than this. It is affected with the demand, output prices, raw material prices, cost of inputs, ability to develop different lines of business and products, foreign risk exposure. So likewise, there are certain other factors also. Including these factors, this business risk can be arise because of operating leverage also. Right? So business risk, because of the leverage, two risk categories are rising. One is business risk. So simply, what is the business risk? Volatility of the expected operating profit. So that business risk can be affected, can be arise because of the operating leverage. So then, what is the operating leverage? What is the operating leverage? So operating leverage is the use of fixed expenses. So leverage means use of fixed expenses. So operating leverage is the use of fixed cost or use of fixed expenses in the operating expenses to magnify the impact of changes in the sales in operating income. Right? So leverage we use as a strategy. Right? Is a strategy. Corporate level, strategic level is a strategy. So what is the operating leverage? Is the use of fixed cost in the operating expenses to magnify the impact of changes in sales in the operating income. Right? So, in a favorable economic condition, when we are in a good economic condition, in a favorable situation, higher operating leverage would lead to higher operating income. Because you know that fixed expenses are not changing when the revenue or when the profit is increasing. So that is for a certain period. In the long run, all the variables, all the expenditures are variable. But for a certain period, these fixed expenses are fixed. When you are earning more profit, that fixed component remain as fixed. So therefore, in a favorable economic condition, your sales turnover, what happens to the sales turnover cash flow is increasing with a favorable situation. In a favorable situation, higher operating leverage. The higher operating leverage means use of fixed expenses in the operating cost. Use of higher operating leverage lead to higher operating income. As the cost would not increase with the increase of sales or profit, with the increase of sales and vice versa. Right? So therefore, when we are in the favorable or the good economic condition, you can have certain fixed expenditures in your operating expenditures. So you can take that advantage. This is a strategy. So you will take certain advantage by using high operating leverage during a favorable economic condition. The effect of fixed cost on the operations can be understood with the analysis of degree of operating leverage. Right? So I define you leverage, business risk, and the operating leverage. So how do you identify, how do you calculate this one? So quantitatively, you can calculate degree of operating leverage. So by looking at this number, degree of operating leverage, you can identify the impact of fixed cost on the profit. The impact of the fixed cost, how impacted to the return or the profit. So let's identify with the example also. Right. So degree of operating leverage you can calculate using this formula. Degree of operating leverage is the extent of operating leverage and the exposure to business risk of a company. Right. Operating leverage is a factor affecting to the business risk. So extent of operating leverage and the exposure or the business risk you can measure through this degree of operating leverage. So that is equal percentage change in operating profit. EBIT means earning before interest and tax. Percentage change in EBIT divided by percentage change in sales. So degree of operating leverage reflects the sensitivity of operating income to the changes in the sales. Right? So operating leverage you can measure using this degree of operating leverage. So how to calculate it? Percentage change in EBIT divided by percentage change in sales. So this shows us when the sensitivity of this profit to the change in the sales. Sales වෙනස් වෙනකොට profit එක කොච්චරද වෙනස් වෙනවා. ඒතකොට ඒක වෙනස් වෙන ප්‍රමාණය indicate කරනවා අපි ගාව කොච්චර fixed cost තියෙනවද කියලා. Simply that is the meaning. So it shows the sensitivity of operating income to the changes in the sales or the revenue. Right. Now look at this example. Very simple example to understand because this is defining the concept only, right? So this is leverage, now the business risk and the operating leverage. So you are provided with the following information for the two companies, M and N. Both produce 200,000 units using different technologies. So you can see sales 20,000 in thousands, 20,000, 20,000. Cost of sales, both companies are having same. Gross profit like this. Then operating expenses under this. For the company M, variable expenses 4,800. Company N 1,600. Fixed expenses M 1,600. N 4,800. EBIT operating profit 5,600, 5,600 both are same. It's a different technology. Now, by looking at this simple income statement, if I ask the question, which company has high operating leverage? What is the operating leverage? Use of fixed expenses in the operating cost structure. So then, which one with the high operating leverage? Company A or B? Sorry, M or N? N. This one, eh? Because you can say fixed cost 4,800. So this is the company with the high operating leverage. Right. Now, if the cost of sales and variable operating expenses are assumed to vary in the same pace with the revenue, the variable cost is changing line with the revenue, and also the sales and the things are variable. Assess the extent of business risk exposed by each company by using degree of operating leverage under each economic conditions. Suppose there is a possible two economic condition in future. Could have a boom. Probability of change in sales if the boom economic situation is occurred, sales is increasing by 10%. Boom means high what you call the turbo economy, meaning economy, boom. So then sales will increase by 10%. If there is a recession, decline in economy, so then your sales will decline by the 10%. So this is normal situation, this is normal, this one. Two scenarios are there, right? So you have to take this into your mind. So now I am going to calculate. Actually, if the time is there, I ask you to calculate the profit and the things. But anyway, because of the limited time, I am going with the explanation. So this is the boom. With the boom, 10% sales is increasing. With the recession, sales is decreasing by 10%. Right. So then this is the income statement. So this is the normal, the given one, normal one. So this is if the boom is occurred. This is if the recession is occurred. Look at the carefully. Now here, with the boom condition, this one sales is increasing by 10%. Okay? Sales is increasing by 10%. So 20,000 should increase by 10%. So now it is 22,000. So if the recession is occurred, there is a drop by 10%. So 20 minus 2,000. So then in line with the sales, cost of sales also changing by 10%. For the here decreasing, here increasing. And also the variable expenses. Variable with the sales or the revenue, it is also going up and down. So now this is, you can see 4,800 should increase by 10% here. If there is a boom, it is a decrease. Now you can calculate, now look at this one. This is for the company M. This one, company M. This is the company with the low operating leverage. So you can see fixed expenditures remain constant. Even though sales increased by 10% or the decreased by 10%, this is constant, 1,600. So then you will get the this EBIT for the boom 6,320, for the recession 4,880. Now we can calculate degree of operating leverage. I think the numbers are there. Degree of operating leverage. If the boom is occurred, so this is the formula. Degree of operating leverage is equal percentage change in EBIT divided by percentage change in sales. Okay? This is the formula. If there is a boom is occurred, this one. So percentage change in EBIT here we can calculate using this one. 6,320 minus normal or the base case 5,600 divided by 5,600 into 100. This is the percentage change in EBIT. Divided by percentage change in sales. So make a percentage change in sales is 10%. 10% 20 to 22,000. So then now new sales is 22,000 minus base normal case 20,000 divided by 20,000. This is 10% into 100. So if you solve this one, so you will get degree of operating leverage. The answer is 1.29. You may calculate it and see whether you are getting. But anyway, if the time was there, I asked you to calculate this one. Now this is percentage change in sales is 10%. This is 12.86. Check whether you are getting this 12.86. Percentage change in EBIT. 6,320 minus 5,600 divided by 5,600 into 100. So that is 12.86. So then degree of operating leverage you can calculate using this formula. Percentage change in EBIT 12.86 divided by percentage change in sales 10%. So then you will get this answer. This is the 1.29 degree of operating leverage. 1.29. So what is the meaning of that? How to interpret this? For the company M, if sales increase by 1%, if the sales increase by 1%, EBIT is increasing by 1.29. That is the meaning. If sales increase by 1%, if sales is expected to increase by 1%, EBIT or the operating profit of the company is increasing by 1.29. Other side of that is if sales is decreased by 1%, sales are down, profit is decreasing by 1.29. So that is the way of interpretation. Degree of operating leverage, this is for the company M. Company M. So you better to calculate and see these numbers whether you are getting. Right? Same way you can calculate here also for the recession. So then it will be minus 12.86. Again, 18,000 minus 20,000 divided by 20,000. So then you will get 4,880 minus 5,600 divided by 5,600. So you will get answer here 12.86 minus. So minus to minus there is a trade-off. Then you will get same answer 1.29 for the precision also. If you have any question, you can ask that. So this is for the company M. So same thing you can calculate company N. Same way, company N. Now here you can see fixed expenses 4,800. Our example, go to the example, see, for the company M, fixed expenses 4,800. So they are with the high operating leverage. Yalage cost structure to fixed cost component එක වැඩි. So they are with the high business risk as well as high operating leverage. Right. So now if you calculate the for this company in same way 10% increase, 10% decrease. So now you can see degree of operating leverage is 1.86. For the company M, it is 1.89. For the company N, it is 1.86. This is the degree of operating leverage. So the company N is the one with the high fixed cost, high operating leverage. So how to interpret this one? Same way. If sales increase by 1%, if sales is expected to increase by 1%, this company operating profit is increasing by 1.86. In a favorable economic condition, this company N will have some advantage. Suppose unfavorable situation, recession, downside of that, this one, if sales decrease by 1%, the profit, operating profit of the company N is decreasing by 1.86, but company M 1.29. That is the business risk. That is the business risk. Ek thamai business risk. Sales decrease una, this company profit, operating profit is decreasing by this much, 1.86%. But this is the company with the low operating leverage. Its operating profit decreasing only by 1.29. right? Okay. Now you go to the definition. If I go to this one, in a favorable economic condition, higher operating leverage would lead to higher operating income as that cost would not increase with the increase of the sales. In a favorable economic condition, we have to know that. In a favorable economic condition, then the company any operating leverage වැඩි. එයාට තමයි වැඩි leverage එකක් තියෙන්නේ. එයාට තමයි වැඩි fixed cost එකක් තියෙන්නේ. In a favorable condition එකක sales anything ගියොත් the profit එක 1.86 වලින් ඉහළ යනවා. මෙයාගේ only 1.29. මෙයාගේ leverage එක අඩුයි. fixed cost අඩුයි. හැබැයි in unfavorable situation මෙයාගේ risk එක වැඩි. Because high operating leverage. Look at the first bullet. Operating leverage refers to the use of fixed cost in the operating expenses to magnify the impact of changes in the sales in the operating income. So as a finance manager, you should have maintained proper level of leverage, proper level of operating leverage in order to magnify the impact of sales on the operating profit. So that is why I mentioned this is a strategy. This is a strategy. Fixed cost is required, but to a certain level. Leverage එකේ අර සීසෝ එක වගේ ඔයාලට වැඩි එකක් පල්ලෙහාට යනවා. අපි යම් කිසි මාර්ගයක leverage එක තියාගන්නවා. ඊළඟට එක්ක ඔයාලට වෙන කවුද? So this is the business risk and the operating leverage. Any question? Okay. Right. So later you may calculate this thing. For the exam also you will get one question on this, right? So this is the business risk and operating leverage. Now this is company M. This is company N. Now the next one is financial risk and financial leverage. What is the financial risk? It depends on the nature of securities issued in raising capital. Financial risk is like a business risk. So financial risk depends on capital structure. Nature of the securities issued by the company in raising capital. Right, so these are two capital structures. This is company A, this is company B. Right? So they have financed say 80% from the equity capital, 20% from the debt capital. This company 80% from the debt capital, say 20% from the equity capital. You know that when we are using debt capital, so what are the sources of debt capital? Like corporate debentures, bank loans, even preference shares are also part of debt capital. So in debt capital, so company has to bear fixed cost. We have to pay fixed interest. Dividend for the preference shareholders, fixed. If it is a bank loan, you have to pay fixed interest. So with the debt capital, you will get the fixed cost. Equity capital means variable cost. Dividend is not fixed. Some dividends zero, some dividends one. So this is a variable cost. So then, if I ask a question, now what is the financial risk? Depends on the nature of the securities issued by the company in raising their capital. It can be defined as the additional risk concentrated on the shareholders of the business as rising the high financial leverage. Now, if you look at these two capital structure, which company has high financial leverage? Capital structure is a fixed cost like a very model company. This one. 80% debt capital. This company has high financial leverage because they have to have fixed interest, fixed dividend more than this. So then what is this financial leverage or the financial risk? So it can be defined as the additional risk. May risk get harder to the shareholders, to the owners of the business, as they are using more debt. So this is the additional risk concentrated on the owners of the company as a result of high financial leverage. So again, this is a strategy. So as a financial manager, you should be able to maintain proper financial leverage, proper level of DP. That is, we are coming with the optimal capital structure. So as a finance manager, you should know what is the optimal capital structure that magnifies the return to the shareholders. So this is financial risk and the financial leverage. So financial leverage refers to the use of fixed cost sources of financing. I explained it. Fixed cost sources of financing, like corporate debentures, bank loans, preference shares. These are fixed cost sources of financing used to acquire assets of the company. Higher financial leverage, FL means financial leverage, would result in the larger fixed outflow. We have to pay fixed interest. After profit, interest fixed dividends given. So therefore would result in the large fixed outflow funds from the company, operating income, leading to the higher financial risk. So again, this higher financial risk bear by shareholders. So therefore, as a financial manager, you should manage this financial leverage also in the way that magnify returns to the shareholders. So extent of financial leverage and exposure we can calculate using this formula. Now, if there is an additional risk, now this financial risk is high when the financial leverage is high. Then may risk how the bear karana? The risk how? Ultimately, it is going to the owners of the business, shareholders. So if they are taking additional risk because of this high financial leverage, they should compensate with the additional risk. Conceptually, if they are bearing additional risk when there is a high financial leverage, so theoretically, they should have some additional return for this financial risk. May risk return ඒක තමයි finance manager කරන්න ඕනේ. ඒකට එයා properly මේ financial risk එක manage කරන්න ඕන. shareholders ලට return එක intensify වෙන විදිහට. So that is the strategy again. Right? Conceptually, are you okay with the financial risk and financial leverage? මේ මම concept පහ විතරයි කියන්නේ. So I explain leverage, business risk, operating leverage. Now, financial risk, financial leverage. So degree of financial leverage you can calculate again using this formula. Percentage change in earning per share, EPS means earning per share, divided by percentage change in EBIT. Percentage change in earning per share divided by percentage change in EBIT. So this degree of financial leverage shows us the sensitivity of earning per share to the change of the operating income. අපේ income statement එක ගත්තම ඔය දෙකේ එකතුවක් තමයි තියෙන්නේ. උඩ තියෙනවා business risk එක, යට තියෙනවා financial risk එක. इंटरेस्ट ऑर्डर करने आप इनकम स्टेटमेंट के याद हरियන්නේ අර මේවා ටැක්ස් එක ගෙවුවට පස්සේ ඒතර එතන තමයි ෆයිනෑන්ෂල් රිස්ක් එක වෙන්නේ. උදාහරණයක් වෙනවා බිස්නස් රිස්ක්. So the combination of business risk and financial risk is the income statement. Right? It shows the sensitivity of the earning per share to the change in the EBIT. Let's assume like this same example. Assume tax rate for both companies 30%. Do you have any questions after this? Any question? Last? Okay. Huh? Right. Applicable tax rate is 30%. So illustrate how financial leverage magnifies the returns and risk to the shareholders. Okay, then the additional risk to the shareholders. By using the degree of financial leverage, you can have understanding about how this financial leverage magnifies return to the shareholders. The additional risk and risk return is so then by calculating this degree of financial leverage, illustrate how financial leverage magnifies the return and the risk to the shareholders. Assess the extent of financial risk faced by the firm M and the firm N using degree of financial leverage. So let's again, I will show you the numbers. Then within make an So suppose these are the capital structures for the company M and company N. Total assets they came to someone 7.5 million. This 7.5 million company M has financed totally with the equity capital. 100% equity capital. Is there a financial leverage? Zero. No financial leverage. Total equity capital. So the company in 7.5 million asset requirement they have financed through 20% from the equity, 80% from the debt capital. So that is their capital structure. Number of shares, there are 300,000 shares equity, there are 60,000 shares. So these are their capital structures. So now we are going to calculate degree of financial leverage, this one. Change in earning per share, percentage change in earning per share divided by percentage change in EBIT. Right. So this is for the company M. Look at this one. So now this is for the company M. So the company M is the one fully equity financing. Operating leverage is how much? What is operating leverage? Company N. Operating leverage. So then this is fully equity financing. So make profits 6,320. You can remember this one. Company M with the boom, you will get the profit 6,320. With the recession, you will get 4,880. So, rate account can you 6,320, 4,800. So, this is the base case. So, no interest for the company M, no interest because fully equity. So, interest is zero. In a earning before tax, 6,320, 4,880. Tax rate was given 30%. Tax rate 30%. So you have to calculate 6,320 into 30. You will get this answer. The net income 4,424. If the boom is occurred, number of shares was given 300,000. So this is the earning per share. 300 number of shares will make a earning per share for the boom 14.75, in the recession 11.39. So you can calculate degree of financial leverage. What is the formula? Percentage change in earning per share divided by percentage change in EBIT. So the percentage change in earning per share again calculate percentage change in earning per share is equal, in the boom you will get 14.75. 14.75 minus, in the normal case, 13.07 divide by 13.07 into 100. So you will get this 12.86. This minus this, or P1 minus P0, a formula. This is the new one minus previous, normal case, divide by the previous. Make a ඉස්සල්ලාත් අපිට ආවා 12.86 change in the EBIT අපි previously calculate කරා, it was 12.86. So now degree of financial leverage 1. Degree of financial leverage 1. So how to interpret this? If EBIT increased by 1%, earning per share also increasing by 1%. And no debt, no leverage, no financial leverage. This is fully equity financing. EBIT එකකින් වැඩි වුණොත් එයාට earning per share ඒ ප්‍රමාණය වැඩි වෙනවා. So that is the meaning. If the EBIT decreased by 1%, earning per share also decreased by 1%. So this is for the company N. Am I split? මේ ගණන් හදලා තමයි කරන්නේ කියලා find නැහැ. So I gave you the answer, so you can later check. Okay. This is for the company N. So now calculate for the company N. So let's see for the other company N. This is for the M. Right. This is for the company N. Again, this 6,640, 4,560 we calculated earlier. EBIT change. Right. So now there is the interest. How this 480 is come? From the 480 ending. So if you go to the question, you can see there is 60% debt capital. There were 7.5 million money, 60%. Here total asset requirement is 7.5 million. Making 80% debt capital. Here is 6 million. So 6 million debt capital. It is interest rate here. 8%. So another 408. Right? So that is the interest cost. This one. 480 is calculated like this. 8% interest cost is there. Then you can see EBIT after deducting the interest 6,180. Tax rate is 30%. So you should pay the tax on the profit. So net income for the boom and the recession like this. And number of shares was given. 60,000 was given. May 60,000 Galle dila thiyena. May company ke may capital structure ke this is the number of shares. It is 60,000. So then earning per share for the company N 71.87 under the boom. Recession 47.6. So like earlier, following the same procedure, you can calculate degree of financial leverage for the company N. It is 1.09. Company M in degree of operating leverage, degree of financial leverage. The degree of financial leverage for the company N was 1. Now here for the company N 1.09. So now what has happened? So this is the company M is the one with the high financial leverage. 80% debt capital is their capital structure. Their financial leverage is very. Medical debt capital is still. So now, if EBIT increased by 1%, EBIT increased by 1%, earnings per share for the company N is increasing by 1.09. Have I made it? Only by one. What is the reason? What is the reason? High fixed cost sources of finance. And then favorable economic condition like EBIT economic model economic condition returns cash flows have a fixed component fixed. Either after equilibrium provided, shareholders are equilibrium provided, in a favorable economic condition. It is not leveraging. In a favorable economic condition, if EBIT increased by 1%, earnings per share for the shareholders is increasing by 1.09. But given that the shareholders additional risk component financial leverage is additional return in a favorable condition. In a favorable situation. Downside in an unfavorable situation, if the EBIT decreased by 1%, one take the financial risk. In an unfavorable economic condition, if EBIT decreased by 1%, earnings per share by 1.09. Only one. Financial leverage. In unfavorable economic condition, EBIT earnings per share but for the company, financial leverage is high. If the EBIT decrease because of the unfavorable economic condition, earnings per share is decreasing by more than that, 1.09. So that is the additional risk. That is the financial risk. Make a risky, as a finance manager, you should manage this inappropriately. So that is why we call leverage. It is not tolerance. Leverage is tolerance. Tolerance can make any right. So this is the financial risk and financial leverage. Combined leverage. What is this combined leverage? Of this so what is the combined leverage? So that is we call total leverage or the combined leverage. So combined leverage is equal and this is degree of operating leverage into total effective. Degree of operating leverage into degree of financial leverage. The degree of operating leverage आपको measure करें percentage change in EBIT divided by percentage change in sales. Degree of operating leverage आप measure करें the percentage change in earning per share to the percentage change in EBIT. इधर मेजर के combined impact का गाना पड़ता है में So combined leverage means percentage change in earning per share to the percentage change in sales. That is the combined leverage. So combined effect, both operating and financial leverage can be identified through the combination of these two leverages. So it could depends on the total fixed cost. You may highlight this. It depends on the total fixed cost. Operating fixed cost as well as financial fixed cost. Both. The income statement is total leverage. Combined leverage. It would depends on the usage of total fixed cost, both operating and financing. The operating part again tama business risk එක ඉන්නේ. Financing part again tama financial risk එක ඉන්නේ. So combined leverage reflects sensitivity of earning per share to the change in sales revenue. So that is you can calculate. Then after making combined leverage you can get then balance company MA 1.29 into 1. So that is 1.29. Combined leverage company N 1.86 into 1.09. Isn't it? 2.03. 2.03. Then balance make a company in operating leverage is high, financial leverage is high, so combined impact also high. So where sales if increases by 1%, earning per share is increasing by 2.03. Here, if sales increase by 1%, earning per share increase by only 1.2. So make a total risk in the balance. Make total risk in the balance. Both business risk and the financial risk. Make 2.0 business risk and the financial risk. If sales increase by 1%, earning per share is dropping by 2.03. That is the meaning. So they are high risky, high return. Favorable return. That is the return. Risk is the review. So that is the high risk, high return situation. So firm N reflects higher combined leverage compared to M, resulting in higher exposure with both operating and financial risk, business and financial risk. Right. So I define you leverage, business risk, operating leverage, degree of operating leverage, financial risk, degree of financial leverage. Okay. So you should be able to calculate, interpret things like this. Any question? Are you okay with that? Isala? Sasal velada ne? Right. So the last concept is optimal capital structure. That is optimal capital structure. So I told you that this value is affected with the cost of capital. එතකොට මේ value එක දැන් අපේ formula එකට ගියොත් මම මේක link එක ආයෙ පෙන්නනවා. So value is equal cash flow expected in future discounted by some discount factor. So this is our cost of capital. This is our cost of capital. The way cost of capital එක ඇතුලේ තියෙනවා use of fixed cost and also use of fixed operating expense. The මේක manage කරන්න ඕන මෙයා maximize කරන්න. මේවා මේ deep concept එක මේ I'm just telling you the definition. So the other thing is maintaining optimal capital structure. So what is the optimal capital structure? I will define it in a very simple way. Optimal capital structure is the capital structure where weighted average cost of capital is minimized and the value is maximized. That is we define as the optimal capital structure. Is a capital structure having minimum weighted average cost of capital and maximum value of the company. In මෙයා minimize කරනකොට when the discount factor is minimizing, මේක ඉගෙන ගන්න. දැන් අපි පුළුවන් තරම් මෙයා minimum තැනකට මේක උඩගෙන යන්න තියාගෙන ඉන්නවා. So that is optimal capital structure. So that is where the weighted average cost of capital is minimum and maximize the value of the company. So target capital structure කියන්නේ අපි තාම මෙතනට ඇවිල්ලා නැත්නම් අපි දැන් ඉන්න capital structure එක අපි target කරනවා. So we have to go to the optimal level. That is we call our expected capital structure. That is we expect to operate in future. So we call as the target capital structure. So this definition is important. So now if you look at these two, again I will explain with the example. So these are some possible combination of the debt and equity. If you look at here, amount borrowed. Right, amount borrowed 0, 1.5 million, 4.5, 7.5, 10.5 million, 15 million. So these are the cost of borrowing, cost of debt. KD කියලා කියන්නේ cost of debt. This is cost of equity. So for the exam you will get a possible combination of like this, and you will ask to identify optimal capital structure. Right? So then what you have to do, so you have to identify weighted average cost of capital, they are the minimum. If you know the weights, component cost of capital, debt and equity, you can calculate weighted average cost of capital. The cost of capital along with these. Right? So now these are the different combinations. Possible combination of debt and equity for this alpha PLC enable them to maximize its value. So identify the optimal capital structure. The remaining of the if alpha PLC total asset value is 15 million. Total asset value given as the 15 million. Applicable tax rate is 30%. So identify the optimal capital structure. The optimal capital structure you can identify by calculating weighted average cost of capital WACC for each level. The weighted average cost of capital calculated है मत Now if you take here total total asset requirement is 15 million. 15 million. The 15 million money, whether 1.5 is the borrowing. Then whether rate here total asset is 15 million. May 15 million में आप finance कराएंगे from the debt capital amount borrowed में 1.5 million can make चला इधर ठीक है चला 15 million running 1.5 को कितने? This is from the debt capital and equity weight लिखिए 13.5 million है 13 मेरे 13.5 इधर दें कैलकुलेट कर मेरे weight मेंचर क्या किया तो debt capital weight weight for the matrix calculate करना तो चलेगा मेरे weight for the each source of capital एक 10% भी तो रहेंगे हमें clear मेथड weight debt weight clear see है 10% दोगे मेथड को 15 million इसके ज़ाहिर खाली make 10% make 19%. And පළවෙනි අවස්ථාවට bracket එක මොකක්ද දෙන්නේ? Weighted average cost of capital is equal cost of equity given. මම මේ calculate කරන මෙතනද දැන් මෙතනට calculate කරනවා නම් කිසි ප්‍රශ්නයක් නැහැ මේකම තමයි math එක වෙන්නේ. මොකද borrowing නැහැ නේ මෙතන. එතකොට මේක වැඩි කිරීම මේක කියන්නේ 8%. Weighted average cost of capital also 8%. But I am calculating for this level. එතකොට මෙතන 8% equity එහෙනම් 100ට වැඩි කිරීම 0.9 plus Cost of debt. This is before tax basis. Tax rate this is on the before tax basis. So you have to adjust it for the tax shield. 6 after tax basis 6 into 1.53 into 10%. So this is the weighted average cost of capital. How much the WACC? 7.62. For each level of borrowing, you have to calculate weighted average cost of capital. That means 7.62. Like this. The next level for each level you have to calculate. What is the optimal capital structure? What is the definition of the optimal capital structure? It is the capital structure where the weighted average cost of capital is minimum. So, minimum we are going to employ that value is maximized. We identify WACC එක minimum වෙන තැන. දැන් මේ බලන්න borrowings වැඩි කරගෙන යනකොට here 1.5 4.5 amount of borrow WACC decreasing. Weighted average cost of capital is decreasing. What is the reason? Debt capital leverage financial leverage with the debt financial leverage is increasing. So when the debt portion is increasing, you can see the cost WACC is 8%, 7%. If it is totally equity financing, this is the cost. Debt so the cost is decreasing. So what is the reason for that? Anyone? Business finance you may try it. What is the reason? Oh, impact because of leverage financial leverage borrowing financial leverage what is the reason for this decreasing of the weighted average cost of capital when the debt is increasing? But because of debt capital oh, this is what? Yeah, tax shield cost 10% really we are getting some tax advantage. Tax shield is there. Because it is a tax deductible expenditure, so you will pay less than that. So on that you are getting advantage. So this is decreasing because of that tax shield. To a certain decrease, the method 7.5 million borrowing back in a decline. Weighted average cost of capital is decreasing. Have I eaten a hard borrow financial risk? There are borrowing wedding in our capital structure 10.5 million borrowed. So now it is a risky. Financial leverage is high. Financial risk is high. So this is because of the agency problem, agency cost, high financial leverage, high financial risk. Now you can see cost is increasing. Right? Up to certain point, WACC is going upward. Initially, it is decreasing because of the tax shield, tax advantage. අපි අසීමිතව බරව කරොත් අපේ leverage එක ගොඩක් ඉහළ යනවා. ඒක හොඳ නැහැ. So then you will get that risk. So then you can see that is increasing. එතකොට අපේ value එක පල්ලෙහාට යනවා. value එක පල්ලෙහාට යනවා. අපේ objective එක achieve කරගන්න බෑ. එතකොට ඒකයි මම කිව්වේ leverage කියන්නේ තෝලනය වෙන දෙයක්. So we have to keep it in the proper point, optimal point. So then what is the optimal capital structure here? So for the exam, you should be able to identify the optimal capital structure. What is the optimal capital structure? 50% debt, 50% equity. In this case, in this example, optimal capital structure is this one, this highlighted one. So 50% from the debt capital, 50% from the equity capital. So this behavior of this weighted average cost of capital you can see like this. When the debt ratio, borrowing is increasing, that is decreasing like this to optimal point. May become optimal capital structure. So this is the optimal capital structure. You will face the agency problem. So you will have some agency cost. There are certain theories to explain this. And also the distress. You will get the distress. Unfavorable situation, you will done the debt borrowing can fixed cost. Either you will face to the financial distress. So you will be a financially bankrupt. If the economy went worse, big problem. So then you can see that is increasing. So this is the optimal capital structure. This is the optimal capital structure. So this is because here tax shield. Make a dual tax shield. This profile and the tax sheet. Right. So I think I uploaded that reading material related to this one. So these are the determinants of the optimal capital structure. All these factors are explained in this bit QA. So you have to read. Importance of the company retain the full control of the business. If the director board want to control the business, so then are you borrowing more? So these are some factors affecting to the optimal capital structure. Debt capital structure is a factor. If you want to keep the full control, so you may borrow less or low, may go high. You will read it, right? With the debt capital, after local influence equity issue there is an influence to the company from the shareholders to a certain degree. So therefore, if you want to keep the control of the business, so you will increase the debt capital. So then they have no certain rights. So therefore, you will issue the debentures, preference shares, things more than the equity. So these are one factor. And also the precise identification of payments made in the future. If you want that, so you may increase the debt capital. I have done no fixed interest rate, fixed dividend rate. So correctly you can identify expected cash outflow. So if you want to identify precisely what is the payment you have to make in future, so you may increase the debt capital. Ability to company to make the fixed regular payments, so you can increase debt capital if you have ability. And also the growth opportunities. Suppose that economy that may we are seeing that we are in a very good situation. Our economy is going to the prosperity. So then you can increase the leverage to get the advantage of that. Leverage advantage you may increase the borrowing. You may have some certain fixed cost in your capital cost structure. With the growth opportunities, you can increase the leverage. And also the average level of leverage of the industry. So you have to compare with the industry, whether you are in the high or the low leverage situation. If you are borrow industry industry leverage is high. That is also one factor. Credit rating. If the financial institutions, lending agencies, if they have identified me as the good credit-worthy people, so you can increase the borrowing because they are providing loans to a fair rate. If our creditworthiness is high, so therefore you can increase the borrowing. And structure the assets available for the company to be used as the collateral. Then අපි borrow කරනකොට debentures bonds වගේ issue කරනකොට you have to keep certain collateral. You know that අපසුරකුත් තියන්න වෙනවා. collateral කියන්නේ අපසුරකුත්. So if you have certain assets to keep them as the collateral, so then you can increase the debt capital. You can increase the borrowing. So these are some factors. Impact of the government tax rate. මේ කොහොමද explain කරන්නේ? tax rate එක වැඩි වෙන වෙලේකට අපි borrow කරනවද අඩු කරනවද? දැන් tax වැඩි වෙන වෙලේකට borrowing වැඩි කරන එකේ පොඩි advantage එකක් තියෙනවා. ඒ අපිට tax shield එකක් තියෙනවා. So then you can increase the debt capital. And also the business risk the company exposed to. ඒතර අපේ මොනවාද තියෙන business risk factors? ඒතර ඒ factors එක්ක අපේ තව fixed cost උත් වැඩි කරගෙන ගියොත් තවත් වැඩි වෙනවා. So then you have to evaluate these factors when you are deciding the optimal debt and the equity level of the capital structure. So these all factors are in the trading chapter. And also this leverage and these variables also are explained there. So please read. You have 2 weeks study leave. 2 weeks study leave. So you have to read. So this is end actually. Capital structure and leverage. 2 weeks later. Yeah. 1 week then. 2 weeks ke lagi. Huh? Only next week. Right. Now look at this question quickly. Following information is available with regard to the two peer companies operating in the same industry. United PSC and the Havelock PSC. Briefly explain the nature of business risk, financial risk faced by the two companies. Right, emphasizing the advantages and disadvantages for the each company. So you are given degree of operating leverage and the financial leverage. So by looking at these numbers, you should be able to compare and contrast these two companies. Like what is the financial leverage, business leverage? Which company has the high business leverage? This one, United because 1.93 is so high business leverage. About financial leverage, a company because you should be able to compare, contrast, and also you can calculate combined leverage even for these two companies also further analysis. Make a thorough. So this is identify the optimal capital structure. So I am going to quickly show you your model paper. I want to tell something about this. This one. So normally the paper will be like this. So the two sections are there. First section compulsory question for 40 marks. So probably it will be on the cost of capital and the capital budget. Right? I have uploaded this to the LMS also. So I think you are in a position to answer these writing questions. I will try to balance between now this coordinate 15 from the writing calculation say 20 hari mama balanga now more on the calculation whether because if it is a question I have to allocate the proper marks no. So you have to look at the cost of capital budget related things. So that is the compulsory question. Either make a meva ke should be able to do. Yes, I am not telling I am giving this one, right? That's not the point. But anyway, cash flow estimate karana, project evaluate karana, you should have a ability. And make answer I will share with you. So the unit price make a calculate this is the answer for this one actually. This one is the answer. Right? So I will share this one with you. You can take the photo නේ මේක මේ වෙන paper එකක් තිබිච්ච ප්‍රශ්නයක් එක්ක මේ මම හදලා තියෙන මේ type එකේ question එකක්. So you can take the photo of this. So this is the answer for this question. So cash flow estimation, you can remember initial cash flow, terminal operating cash flows, and the terminal year cash flow. And then based on that, you have to calculate NPV to decide whether you accept or not. May skill eකට ready වෙන්න. Okay. Then in addition to that, there are 5, 2, 3, 4, 5, 6 questions. These are from the 15 marks. The making one select the 4 questions. So you can see this question. This one. Look at this one. This is based on the today's discussion. This Exxon PSC recently registered company operating in the apparel sector. Considering the higher growth potential in the future, the company is currently planning to undertake an expansion project requiring new capital. Thus, the company now considering ways of financing this expansion. You are newly appointed finance manager of this company. You are assistant how to prepare for the following information. You are provided industry average, industry average, and also this company change in sales, change in EBIT, change in earning per share is given. With the appropriate calculation, provide your recommendation to whether this project should be financed through more debt capital or more equity capital, or by considering the external existing business and financial risk exposure. So this is your question from your model paper. So you are provided change in EBIT, change in sales, change in earning per share, and the industry as well as for your excellent companies given. So you are asking this expansion project finance karagana more than the more equity the So that is the question. So then to tell that one, you have to calculate what. Then considering the higher growth potential in future, the company is currently planning to undertake the project. Industry compare you have to compare the numbers of this company with the industry. Industry factor industry average is effective. Because then you can calculate degree of financial leverage for the industry as well as for the company. From the degree of financial leverage calculate percentage change in earning per share divided by percentage change in EBIT. So calculate that for the industry and this company. Tell me what are the answers. Degree of financial leverage. And also you can calculate degree of operating leverage also. Calculate there any promotion? Is there any function? Huh? So you will get the answers like this. These are the degree of operating leverage for the industry and this company, and the degree of financial leverage. So by looking at these numbers, you should be able to tell whether you are going with the debt capital or the equity capital. Compared to the industry, operating leverage of this company is low. Again, use of fixed cost in the operating expenditures compared to the industry. Industry getting other companies are සාපේක්ෂව අඩුයි. And also the compared to industry මෙතන මොකක්ද තත්ත්වය? Degree of financial leverage. Industry එකට සාපේක්ෂව company එකේ financial leverage එක මොකද? වැඩි. එහෙනම් අපිට කියන්න පුළුවන් මේ project එක expand කරන්න using debt කියලා. Which one you recommend? Again, my answer, are you recommending debt capital or equity capital? Can you recommend use of debt capital? Then, because their financial leverage here more than the industry, can they are borrow karna thiyena oda. That is the meaning. So therefore, compared to the industry, high degree of financial leverage reflecting the high financial risk. So therefore, better to finance the operation with more equity capital. With the more equity capital. Right? So by looking at these numbers, such a decision you should be able to take in the exam. That is my expectation. Calculation eකට වඩා number එක දුන්නා you should be able to take some decision and provide some recommendation. So like this. Right. මේ model paper එකේ අනිත් questions I think you can manage. In any case, if you need, you may contact me, no problem. So you may go through this. I provide the answer for this cash flow one also. If you have any questions, any clarification, you may ask, no problem. I think Mr. has the number. Or better to put a mail even, I can assist you. That's all. And also I want to show you your continuous assessment mark as I promised. So these are the numbers I gave already. You can, all are having greater than 30. So out of 40, 30, 34, 37 recordings I learned, but I'm not satisfied with that one. But anyway, with the time problem, okay. Right, so these are your continuous assessment. හරිද? කොහොමද ඉතින් උඩ ඉන්නවා එතකොට පේපර් එකට මහන්සි වුණාම all can go 60 for the paper, 30 for the continuous assessment, 40% for the continuous assessment, 60% for the paper. Right? Right, that's it.